All right, welcome everybody. Thanks for coming. Thanks for joining our VARC Solutions Bookkeeping Academy. For those of you that this is your first time, welcome. Thanks for coming. Our goal is to really be a service to you and a value to you, and really just help uh, provide to you quite frankly, some basic education, but also some good discussion Q&A. I'm going to go ahead and pull up the um, spreadsheet, so to speak, of topics that we're talking about today, and also kind of what we're talking about over time. If you don't have a link to this document, let me know and I can send you a copy of it. But basically, we just started this 2 or 3 weeks ago with the goal of really just building a foundation of knowledge for bookkeepers, people who are QuickBooks consultants, etc., covering core QuickBooks concepts, core accounting concepts, with the ultimate goal of being better and better at what you do, so that you can not just do bookkeeping, but also do consulting and advising. But it's really, really hard to be a consultant and an advisor if you have some gaps in the basic accounting fundamentals. And so that's part of what we're trying to do here. Just a real quick recap. Last couple of weeks, we've kind of talked about like cash versus accrual accounting and how that's different than taxes. We went through the statement of cash flows, which is kind of a mysterious financial statement for most people. Today, we're going to talk about maximizing profit or minimizing profit, because we have clients that have different opinions about that. And so, for example, next week, we're going to talk about what in the world is undeposited funds, and what is it and why is it used? Okay. And then we'll also be talking about like opening balance equity. What is that? How does it get there? What do I do with it? Just some of those kind of outstanding questions that a lot of people have. Um, Today, again, we're going to talk about maximizing profit and or minimizing profit. We record these as well, so if you miss a topic, you can't come a specific week. We're posting these on our YouTube channel. So if you go to YouTube and go to VARC Solutions, these videos will be posted there as well. Like I said at the beginning, if you have questions, if you have comments, I'm going to do a little bit of 5-10 minutes of chatting here, and then I'm going to open it up for discussion, because you guys have just as much to say about this as I do. But let's go ahead and start with the basic fundamental question, and that is, should I be focused on reducing profit or maximizing profit? Okay. And I hope for some of you, I hope for most of you, that's a strange question to ask. It is a strange question to ask. The reason why I thought this might be a relevant topic is because sometimes we have chats with our clients, and they will say the strangest things. They will say things like, "My financials are saying I made too much money. Can you help me with this?" And then my question back is, "Well, isn't that your goal? Would you not want to make more money?" And of course, then the response is, "Yeah, I know, but if I make more money, I have to pay more taxes." Okay. So there are legitimate reasons why an owner might want to make more money or might want to show that they've made less money. So part of what I want to do is really just share some context around that from my experience, but then again, open it up to you guys for conversations. Ultimately, if you wanted to make more or less profit, so to speak, it really depends on the goals of the business. Okay. It really depends on the goals of the business, because one thing that I've learned is that if you have no intentions of ever selling your business, if you have no intentions of ever exiting your business and making money off of what you've built, then yeah, your goal should be to reduce taxes. Okay. So, that might mean taking more expenses that otherwise would be off the books and putting them into the books so that you show a little bit less money. And we can talk about the gray areas potentially of when that's appropriate, when it's not appropriate. But that's part of what's going on here. And literally, not to name specific clients, but we've actually had clients that say, "Hey, I need to reduce the amount of money that I'm showing as a profit." Now, okay, we can help with that. Obviously, we want to get CPAs involved. We want to get tax people involved. We don't want to be doing anything that's not legitimate and appropriate. Okay, but it's a legitimate conversation to have, because, quite frankly, a lot of owners really truly do have a pulse of what's going on in their business. And if they feel like the financials are showing that they made too much money, it could be that a mistake has been made. something that might have been recorded as income now that shouldn't be recorded as income now. Okay, so there are some legitimate reasons here. But let's go back to the central question here, and that's what's the goal of the owner. So, like I mentioned, if there's no plans to sell or exit in the next 5 to 10 years, yeah, your goal might be to reduce your profits so that you can pay less in taxes, ultimately saving more money over time. However, if the owner wants to sell their business or exit their business in the next 3 to 5 years, the goal truly should be to maximize profits and show consistent profit growth along with good and recurring cash flow. Okay, so why is that? Well, if somebody is looking to buy a business, right, one of the things that they want to see is they want to see profit. They want to see growing profit. They want to see consistent profit. And so this is part where we sometimes, even as bookkeepers, need to educate our clients. Like, we need to be able to tell them, hey, I understand what you're trying to do here. I understand you would like to pay less taxes, but what is your goal? Because if you want to get more money 3 years from now or 5 years from now, when you sell your business, you don't want to minimize your income. You actually want to maximize your income. And so it depends on what the goal of the owner is. But if we can help educate our clients on this topic, think of it like this. I could be trying to save $10,000 a year on taxes, but in doing so and reducing the profit that tax is based on, I might end up getting $1 million less than I could if I was to maximize the profit. So, hey, owner, you're doing something here that is short-term thinking. Yes, you might be able to save some money on taxes, but you're losing in the long-term game of growing a higher value business that you could then sell. Okay. Okay. One other caveat here, by the way. We work with a lot of companies, a lot of different sizes. Some are, an owner that started the business, and then they have they might want to sell to an outside party. But there's other family-based businesses, right, where I might have, okay, I started this business back in the 1950s, and then I handed it off to my son or daughter, and then they've grown it the last 30 years, and now their plan is to hand it off to their, my granddaughter, that kind of a thing. When you've got sort of generational family-based businesses, you're not looking to sell that business and make 20 million, 100 million, or whatever. You might be like, look, I just want to be able to hand this off to my kids. Okay, different goal. Okay, in that case, you might be just your long-term focus might be tax savings, and that's totally fine. Okay, so if you've heard anything in this, know that both objectives are legitimate objectives. Question is, what is the goal of the owner? And so, like, internally here, when we've had conversations, one of the things I've tried to encourage is talk to the clients and ask them what their goals are. Like, what are you trying to do? What in the next 3 to 5 years, what is your goal? And that doesn't have to be like, I'm trying to sell my business, but like, I had a conversation with a client a couple weeks ago, and they're like, hey, I want to go from a trucking business that has 10 trucks to a trucking business that has 500 trucks. Okay. They're not trying to sell their company. They're just trying to grow a massive company. Well, if you know that, you can help talk to them and advise them on strategies maybe to get there. Okay. So let me just pause for a second and just see if anybody has any thoughts, good, bad, ugly, anywhere in between, on this topic. Anybody have any questions, comments, or otherwise? In the room, Angie, Jay, anything? Catherine, what have you seen, heard from clients?
Typically, they like to minimize profits, and I agree. That's not always they're not looking ahead. They're not.
Right. Yeah. So just clients that are thinking short term, not looking long term, not looking ahead. And I think this is, we work with clients, right, that understand bookkeeping and accounting to some level. We work with some that don't. I think this is an area where we have to step up and advise our clients at a higher level. again, we're not necessarily providing CPA advice. We're not CPAs. We're not trying to provide tax advice. But that doesn't mean we can't give people our opinions and basically say, hey, we're seeing what's happening here. Did you know that there's an alternative strategy that you could be thinking about? Right. Like Jay, I know you listen to a lot of podcasts, and it's, how to be more efficient, how to, niche, grow a niche. And so there's things that you're learning, right, that we could be passing on to clients when we're working with them. So those are just some examples. Anybody else have thoughts or comments? All right. I'm not seeing a lot of questions or comments. Thank you, Catherine, for yours. So let me just throw out a few more things just to sort of round out this topic. Um, like one of the questions that I had is, is it even legitimate to have a conversation about lowering my profit? Okay. Like, is that something I could be doing or should be doing? Um, and so some of the things that sort of came to my mind is, first and foremost, any actual income that we've earned definitely needs to be on the books. We don't need to be not we don't need to be touching that component. If we've earned the income, it needs to be there, period. Okay. However, there are things that a CPA might suggest, in terms of depreciation of fixed assets. They might say, hey, you've got this piece of equipment that otherwise might be depreciated over 10 years, but quite frankly, it's not going to be usable in 3. Like, so we might need to accelerate a depreciation of that asset, which would quite frankly increase my near-term expenses, lower my income, lower my net income. Okay. And that's a completely legitimate thing to do. Okay. There may be legitimate reasons for deferring income to a future period. One of the most common scenarios that I've seen is like big construction projects, big real estate development projects. Okay. I don't want to record income in 2024 if I'm going to be building this construction or this real estate development project for the next year and a half. And, I need to report that income when the project is completed, right? So I might be deferring income to a future period for legitimate reasons. Okay, that might reduce income in the current period, but it's going to increase it in the future period. Some other reasons that I've seen is like owners that elect to pay themselves more or less. Okay, salary payments versus distributions. So salary, is going to hit your P&L as a payroll expense, whereas distributions, I'm taking money out of the business, and that's usually an equity account. Okay, so if I pay myself a salary, that reduces my income, my net income of the business. Whereas if I do a distribution, it has really no effect on the P&L, right? So those are things that, like, if you're in an S corp, you're supposed to pay yourself a reasonable compensation. Okay, so there's I might be paying myself too much, I might be paying myself too little. The IRS obviously wants to get a little piece of whatever I pay myself with employer taxes. But so there's some things like this that are completely legitimate things for an owner to do, but they may or may not be aware of some of those implications, right? Okay. Last thing I'm going to say, and this is just one of the sort of like last examples that I thought of that might be relevant, is, hey, I've made money in the company and I want to do bonuses or I want to do profit sharing. When I pay those bonuses out, makes a difference with my current P&L, right? So if I look at a end of the year and let's say we've made $1 million of net income, and I say, hey, I'm going to pay $100,000 out in bonuses. Well, if I do that before 12/31, it's going to show in the current year. If I do it on 1/1, it's going to show in the next year. So, when you talk about that, you kind of get into a game of, I don't know if this is the right phrase, but cat and mouse. Like, am I doing any good by deferring this bonus till 1/1? Well, it depends, right? So there's not necessarily a good or bad about that. If you pay people bonuses before 12/31, it shows up on their W-2, which means their taxes are going up. Okay, my net income is going down, which lowers my business taxes, right? Okay, so there's pros and cons there. My only thought when you start looking at this type of stuff, and if an owner ever says, "Hey, when should I do this?" My opinion is the key is to be consistent each year. Okay, if you always pay bonuses before 12/31, I think you should keep doing that. If you always pay bonuses on 1/1, I think you should keep doing that. Because if you don't, you're going to get into a lopsided situation where, 1 year, it's kind of like you're doubling up because you paid it on 12/31, or sorry, you paid it on 1/1, but then the next year you pay it on 12/31, and now you've got double the bonuses in that 1 year. That can be a little weird. It could be a little lopsided. And quite frankly, if you ever do go to sell a business and people are looking at the financials, that just becomes another thing that needs to be explained. Why did you do that? Okay, hey, I show it was more this year, less this year. What is that and why was that? So I'm going to stop talking again. Any questions, any comments, any other discussion points on this specific topic? And I'm also asking my internal office staff here room as well.
My only comment is if it's already gone through payroll, don't change it.
That's a good.
You're gonna mess up everyone's W-2s, everything.
Good point. So for those that might not have heard that, Angie was saying, especially when it comes to things like bonuses and profit shares and payroll, if it's already been paid through payroll, don't go changing it. Smart advice. We wouldn't put it past our clients to mess things up, would we? Right. Yeah. So if you've created paychecks, you've printed the check, you've mailed the check, you've deposited the check, you've paid taxes on that check. You're right. You don't want to go changing that stuff just because you want to do it differently. Right. Yep. Good point. Yep. Anybody have an owner? I mean, this is kind of a side topic, but anybody ever worked with an owner that wanted to like do catch up payments for payroll, like they should have been paying themselves paychecks the first 3 months of the year, but they hadn't, and now they found out they're supposed to be. What do you do in those kind of situations? A little off topic, but we're talking about payroll, so.
Double check with their CPA that that's what they should be doing.
Double check with their CPA, make sure that's what they should be doing. Yes, good. So point is, we can't neglect or take the job away from our CPAs that we work with or that our clients work with. Our clients and we should be leveraging those CPAs in those decisions, especially those critical decisions that might impact taxes at the end of the year. So yeah, good point. Good point. When all else fails, ask the CPA. Okay. And by the way, I probably have said this 3 times now. Last thing I'll say about this is what I tell my team, and what I'm gonna tell my team here again today is, I don't want you to be afraid of offering your opinion to our clients. I don't think you should well, that's a CPA thing. I can't say anything about that. I'm not a CPA. I shouldn't give my opinion. Our clients in many cases are relying on us to tell them what we think they ought to do. Okay. So I think it's okay to give opinions. I think it's okay to say, hey, here's what we're seeing with other clients that might apply to you in your situation. So now we're kind of putting on that consultant hat with that advisor hat. Totally fine. When it comes to things like depreciation schedules and amortization schedules and tax strategies, yeah, I mean, let's say, hey, do you have a CPA? If not, we can recommend one to you. Here's what I'm seeing other clients do. Here's what I would suggest. But again, this is, we're not giving tax advice. We recommend you go to your CPA and get their word on that as well. I just don't want you to be afraid to ever give an opinion, because, sometimes our clients are looking for an opinion, and it's okay. Right. So if no other questions, no other comments, I'm going to go ahead and stop the recording today. I hope this was helpful to you, and keep coming and showing up each week, and we will continue adding value, hopefully every week, to your base knowledge of accounting and QuickBooks.